Before we begin, let me ask you a very simple, but extremely important question. If you are not American, you don't live in the United States, you don't use US dollars, and you've never bought US stocks or US government bonds in your life. When financial problems happen in the United States, do they really have anything to do with you? Most people instinctively answer, probably not. Because in our minds, financial crises seem to happen in other people's countries, other people's markets, other people's assets. But over the next several minutes, I want to show you something different. In today's world, where finance is deeply integrated and capital moves globally, systemic stress in the United States almost never stays inside the US. It spreads outward, very quickly, through three main channels. First, the US dollar system. Second, global capital flows. Third, synchronized changes in risk appetite. And the reality usually looks like this. Ordinary people are often the last to be told what is happening, but almost always the first to feel the consequences. You may not know the term, shadow banking. You may never have looked at the Federal Reserve's balance sheet, but you will feel the results in real life. Money becomes harder to borrow. Job opportunities become fewer, and risks suddenly show up all at once. Today we're talking about a concept that sounds scary, but is absolutely critical to understand. Shadow banking. Let's clear up the biggest misunderstanding right away. Shadow banking is not illegal. It is not organized crime. And it is not underground finance. It is a fully legal financial structure that has existed for decades. Think of the financial system as a water supply system. Traditional banks are the main pipes, clearly regulated, pressure tested, equipped with safety valves. Shadow banking is everything that branches off from those main pipes, a network of auxiliary pipes running alongside the system. These auxiliary pipes are more flexible, faster, better at bypassing restrictions. When water pressure is stable, they often look more efficient. But when pressure rises, the first leaks and the first ruptures almost always happen there. Let's keep this very basic. Banks fundamentally do three things. 1. Take deposits. 2. Make loans. 3. Manage risk. The issue with banks is not capability, it's regulation. Strict regulation means high capital requirements, limits on risk-taking, mandatory liquidity buffers. But the real world doesn't stop creating demand just because regulation is strict. There are always borrowers and investors who want higher risk, more complex structures, higher returns, or financing that doesn't fit within bank rules. Those demands don't disappear, they get pushed outside the banking system. And that is how shadow banking forms, a parallel system of non-bank credit intermediation. In the United States, shadow banking includes money market funds, hedge funds, private credit, CLO, collateralized loan obligations, repo financing chains, derivatives and margin structures. You don't need to remember these names. Just remember one sentence. Shadow banking also borrows money, lends money, and amplifies capital efficiency, but without the same capital constraints and liquidity backstops that banks have. In other words, banks move slower, but wear seatbelts. Shadow banks move faster, but have far less protection. A simple analogy. Banks are licensed taxis, regulated, insured, and monitored. Shadow banks are fast, flexible rides without insurance. When everything goes smoothly, you barely notice the difference. When something goes wrong, the difference becomes massive. Shadow banking crises are never random accidents. They don't happen because people suddenly become reckless overnight. They happen because the system is built around three structural risk buttons. Remember these three words: short-term funding plus leverage plus deep links to banks. Each one alone may be manageable. Together, they create exponential risk. Button 1. Short-term funding for long-term assets, liquidity mismatch. This is the simplest and most dangerous problem. On one side, investors can redeem their money at any time. Cash is expected immediately. On the other side, assets are hard to sell and must be sold at a discount if rushed. Examples include private credit, structured credit, illiquid, non-public assets. In plain language, you are using money that can be withdrawn at any moment to buy assets that cannot be sold quickly. Imagine this in real life. You and several friends start a business together. Your friends tell you, this money might be needed back at any time. But you take that money and buy a house or a storefront. Most of the time, it's fine. But if everyone asks for their money back at the same time, you have only two options: sell the asset at a deep discount, or run out of cash entirely. This is where the old rule appears: first out wins. The earlier someone gets their cash, the safer they feel. The later they are, the more panic builds. And panic itself creates more panic. Button 2. Leverage. Margin turns small moves into crises. Shadow banking relies heavily on leverage to boost returns. Leverage comes from repo financing, derivatives, prime brokerage credit. At its core, leverage means one thing. You are buying assets with borrowed money. A familiar example, you buy a house with a 20% down payment. If prices rise, everything looks great. But if prices fall, the lender calls you and says, your collateral is no longer sufficient. Add cash now. If you can't add cash, you must sell. And when everyone is forced to sell at the same time, prices fall faster. That triggers more margin calls, which forces more selling. This creates a self-reinforcing loop. Falling prices, forced selling, even lower prices. These are not rational trades. They are survival trades. Button 3. Shadow banking is not outside the banking system, it is attached to it. This is the most misunderstood point. Many people believe shadow banking exists outside banks. In reality, banks provide credit lines. Banks act as repo counterparties. Banks offer derivatives, custody, and market making. During calm periods, these connections increase efficiency. During stress, they become transmission channels. Think of the banking system as the main power grid. Shadow banking is a network of extension cords. They are convenient, but when one extension cord catches fire, it can trip the entire system. That's why shadow banking failures are rarely isolated. They spread. At this point, let's pause for a moment. If what I just explained, short-term funding, leverage, and deep links to banks, still feels a bit abstract, then let's ask the simplest and most important question. Is this really a recurring problem? Or is it just a theoretical risk? The answer is very clear. This is not something that might happen. It has already happened many times. And once you look closely, you'll notice something disturbing. Across different years, different countries, and completely different assets, the story is almost always the same. Case 1. The 2007-2008 global financial crisis. A shadow banking run. When people think about 2008, they usually remember a few familiar images. Lehman Brothers. Subprime mortgages. A housing market collapse. But if that's all you remember, you're missing the most important part. The first place where the system broke was not depositors lining up at bank branches. It was the short-term funding markets inside the shadow banking system. Back then, a huge amount of credit was structured through ABCP, asset-backed commercial paper, SIVs, off-balance sheet investment vehicles, repo financing, complex securitization structures. All of these had one thing in common. Long-term, complex, hard-to-sell assets were being financed with short-term, constantly rolling funding. As long as confidence held, everything worked. But once markets started questioning asset quality, short-term funding simply stopped rolling. In the shadow banking world, that's equivalent to one sentence. I'm not lending to you anymore. Think about what happens next. Assets can't be sold easily. Funding disappears, so institutions are forced to sell at any price. Once fire sales begin, prices fall far below reasonable levels, which creates even more panic. The real chain of events looked like this: short-term funding freezes, forced asset sales, market prices collapse, the credit system seizes up. This is why we say, at its core, the 2008 crisis was a run on the shadow banking system. Case 2. 2008 money market funds break the buck. When cash substitutes stop behaving like cash. Also in 2008, another event occurred that many people overlook, but it was critically important. In September 2008, a well-known U.S. money market fund, Reserve Primary Fund, saw its net asset value fall below $1. On the surface, that sounds minor. But the market reaction was extreme panic. Why? Because until that moment, many investors believed money market funds are basically the same as cash. Suddenly, the market realized something uncomfortable. What we thought was cash was actually just a cash substitute. Redemptions exploded, short-term funding markets tightened instantly. And if you remember the logic we discussed earlier, you can immediately see the problem. When the place that looks safest starts experiencing a run, the entire shadow banking system comes under pressure at once. Case 3. The 2011 European debt crisis. Quiet, but extremely destructive. The 2011 European debt crisis appeared, on the surface, to be about Greece, sovereign bonds, fiscal sustainability. But what really terrified markets was dollar funding. What many people don't realize is that, Before the crisis, U.S. money market funds were a major source of short-term dollar funding for European banks. As the crisis intensified, those funds didn't withdraw dramatically. They simply stopped renewing funding. Quietly. The result? Dollar funding for European banks shrank rapidly. Funding costs surged. Stress spread quickly through the banking system. Once again, the same lesson appeared. Shadow banking crises don't always explode suddenly. Often, the danger comes from funding slowly disappearing. Case 4. March 2020. The global dash for cash. In March 2020, when the pandemic first hit, something extremely rare happened. Everyone wanted cash at the same time. It didn't matter whether you were a hedge fund, an asset manager, a corporation, or even a pension fund. The priority was the same: turn anything that could be turned into cash. This is when the weaknesses of the shadow banking system were fully exposed. Open-ended fund redemptions surged. Margin requirements exploded. Collateral suddenly became scarce. Many assets that normally appeared highly liquid turned out to be almost impossible to sell or could only be sold at extremely distressed prices. Without rapid central bank intervention, the damage would have been far worse than what we ultimately saw. Case 5. The 2022 UK pension LDI crisis. When long-term money is forced into short-term behavior. This is a case worth emphasizing again, because it shatters one of the most common beliefs among ordinary people: pensions are safe. In the UK, many defined benefit pension funds used LDI strategies to hedge interest rate risk. The problem wasn't the strategy itself. The problem was leverage. When government bond yields rose sharply, bond prices fell. Margin requirements surged. Pension funds didn't have enough cash. Their only option was to sell government bonds to raise liquidity. By now, you already recognize the pattern. Everyone sells. Prices fall further. Margin calls rise. Forced selling accelerates. This wasn't market failure. It was the shadow banking mechanism at work. If you look at 2008, 2011, 2020, and 2022 together, one pattern becomes impossible to ignore. Crises driven by shadow banking are not caused by bad assets. They are caused by the same three forces coming together: short-term funding, leverage, and simultaneous withdrawal of liquidity. The assets can change, the countries can change, but the mechanism is always the same. So how does all of this finally reach ordinary people? At this point, many people still think, shadow banking, leverage, financial crises, this all sounds very distant. I don't trade stocks. I don't work in finance. Does this really affect me? Let me answer that very clearly and very responsibly. Once the financial system starts to contract, there are no spectators. Because money doesn't live only in financial markets. Money lives in your job, your loans, your pension, and your cost of living. The first thing that gets hit: jobs and income. When shadow banking and the financial system come under pressure, the first thing that happens is not a stock market crash. The first thing that happens is much quieter. Borrowing becomes harder. Corporate financing costs rise. Banks and financial institutions become more cautious. When that happens, companies usually respond in only three ways. They stop expanding. They slow down hiring. They cut costs, sometimes through layoffs. So what you feel in real life is often fewer job opportunities, wages that stop rising, more pressure, without a clear explanation. Many people describe this as the industry is bad or the environment is weak. But behind the scenes, it's often the financial system quietly tightening credit. The second impact: mortgages, car loans, and consumer credit. When the system becomes stressed, banks and lenders immediately do one thing: they increase their safety margins. You start to notice that loans that used to be easy to get now require more paperwork. Interest rates are clearly higher. Some applicants are rejected outright. This doesn't mean banks suddenly became greedy or hostile. It means they are defending themselves. When shadow banking and markets show signs of stress, banks don't respond by lending more. They respond by protecting their own balance sheets. The third impact: your investments may not be as liquid as you think. This point is extremely important and often overlooked by ordinary investors. Many financial products are marketed as highly liquid, redeemable at any time, low risk, but the reality is much simpler. Your ability to redeem depends on someone else's ability to sell assets. When markets are calm, everything looks smooth, but when many people try to redeem at the same time, you may face delayed redemptions, queues, sudden downward adjustments in net asset value. You think you're holding cash. In reality, you're holding a promise to receive cash. And when the financial system tightens, promises get repriced. The fourth impact, and this is critical: pensions are not immune. Many people believe pensions are long-term money. They don't matter for short-term market stress. That belief is wrong. If a pension fund uses leverage, if it is exposed to margin requirements, or if it holds assets with limited liquidity, it cannot stay completely isolated. You already heard the UKLDI crisis example. That episode taught us a crucial lesson: pension funds are not the source of risk. But in times of stress, they can be forced to amplify it. And when pensions are forced to sell assets, the impact isn't limited to institutions. It affects market prices for everyone. So a clear pattern emerges: when the financial system breaks, it's not a game for the rich that went wrong. It's a contraction of credit and cash flow across society. And what you eventually experience in daily life is harder to find jobs, harder to get loans, more volatile assets, a more uncertain future. Why this affects you even if you live in Europe or Asia? Now let's return to the original question: if I don't live in the United States, why am I still affected? The reasons are actually very simple. First, your interest rates are often anchored to the US long-term Treasury yields, serve as a reference point for many global interest rates. When they move, European companies face higher financing costs. Asian mortgages and corporate loans become more expensive. You may not use the US dollar, but the pricing rules you live under come from the dollar system. Second, your pension is already global. Modern pension and insurance funds rarely invest only at home. They often allocate capital internationally, hold US assets, or invest in products closely linked to US markets. That means US risk has already been packaged into your future income. Third, shadow banking operates across borders. Money may originate from European pension funds, be managed by US institutions, and be invested across global markets. When stress appears in one place, risk travels along the funding chain and eventually comes back to everyone involved. So you don't need to live in the United States. You don't need to work in finance. You don't need to trade markets. If you have a job, savings, a pension, and future living expenses, you are already part of this system. When the system starts relying on higher risk to maintain stability, ordinary people will be affected. It's not a question of if, only when. This is not fear-mongering. And it's not a doomsday story. It's simply this: when regulators begin relaxing rules, it's rarely because the system is extremely safe. More often, it's because the system is already under pressure. If you want to understand these shifts before they fully materialize, you're welcome to subscribe to my channel.